Broadcom, AVGO, is currently rated a strong buy and the Burkhardt technical opinion rating for is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. Rather than just buying the stock, investors can use the options market to find smart ways to trade Broadcom stock with an attractive risk-to-reward ratio. Implied volatility is high at around 34%. The 12-month low for implied volatility is 19.9% and the 12-month high is 44%. The 4th percentile is 87%. That means it could be a great time to be a seller of options on AVGO. That coupled with the potential bullish action makes it a great candidate for a bull put spread. Option trade idea 1, sell a bull put spread. A bull put spread is a defined risk option strategy that profits if the stock closes above the short strike at expiry. To execute a bull put spread, an investor would sell an out-of-the-money put and then but a further out-of-the-money put. Running the Burkhardt bull put spread screener shows these results for AVGO. Let's use the first line item as an example. This bull put spread trade involves selling the January expiry 530 strike put and buying the 520 strike put. Selling this spread results in a credit of around $2 or $200 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 10 to 2.00 x 100 equals $800. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 25%. The probability of the trade being successful is 76.3%, although this is just an estimate. The spread will achieve the maximum profit if AVGO closes above 530 on January 21, in which case the entire spread would expire worthless, allowing the premium seller to keep the $200 option premium. The maximum loss will occur if AVGO closes below 520 on January 21, which would see the premium seller lose $800 on the trade. The break-even point for the bull put spread is 528, which is calculated as 530 less the $2 option premium per contract. Option trade idea 2, sell a naked put. Naked options are hugely risky and should only be considered by very experienced traders. The potential losses are unlimited, up to the point of the stock reaching $0. That's unlikely to happen in the case of AVGO, but naked puts could still suffer significant losses if the stock has a large drop in price. Naked puts should be traded with extreme caution, and only by large traders. Once again, let's take the first line item as our example. A naked put is a mildly bullish strategy. It will make money if the stock rallies, stays flat or doesn't drop by too much. The first example is selling the 530 strike put option expiring in January. Doing this, the trader would receive a credit of around $13.10 or $1,310 per contract. That's theirs to keep no matter what happens to the stock over the course of the trade. However, the investor does have an obligation to buy 100 shares of the stock at $530 if the stock drops well below that level. With a naked put, the idea would be to try and avoid assignment, by closing early or adjusting. If AVGO stays above 530 and the put expires worthless, the trader makes a 2.5% gain in just over 1 month. That works out to be around 20.1% on an annualized basis. The break-even price for this naked put is calculated by taking the strike price minus the option price. In this case that would be 530 to 13.10 equals 516.90. The maximum loss would occur if AVGO went to zero on January 21, which would see the trade lose $51,690. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull put spread, setting a stop loss of 1.5 times the premium received is a good idea. In the case of the AVGO example above, that would be a loss of around $300. For the naked put, a stop loss of 1.5 times the premium received would also be prudent. In the example above, that would involve closing the trade if the loss was around $1,965.